thank you for being here with us.
It's a pleasure.
I feel like you're a man that needs no introduction, but just in case there's anyone here that doesn't know Milton Ezrati, he is the economist of Vested, former economist and market strategist at Lord Abbott. He's a blogger, but he hates the word blog. He's an author. He's often cited by the media, and he also writes for the media. You're a busy man.
Pleasure to be here.
So the topic for today is the state of banking. And it's an interesting time to be talking about banks. And about a year ago, you came and spoke to us about banks. It was right after SVB and Signature. And you really helped break down what was going on. And what you said then is, this is not 2008 and 2009, which was really an issue of bad debt. Last year was liquidity. And I want to talk about this year. So you put some thoughts down on paper for us. And we're going to go through there because you talked about a lot of risk still being there for banks now. But one of the things you said in your most recent thoughts was that you don't see a repeat from last year happening. But we have seen some banks go down or need to be rescued, right? Republic First.
Say again.
We have seen some banks go down recently.
Yes.
But you don't think it's a repeat of last year.
It's contained.
It's contained.
It's, I mean, if you're looking at Silicon Valley and the other banks, actually, they all had something in common, but they didn't fail for the same reasons. Silicon Valley was almost unique in having an extremely undiversified asset base and extremely undiversified deposit base. So it really made it so it broke all the cardinal rules of investing. And a lot of the problem here is the way the regulators have behaved.
So, not to interrupt you, but you're saying Signature was not a result of the crypto exposure then?
There were problems at Signature, but nothing that necessarily meant that the bank had to be taken over. So the regulators had a different agenda. I don't know what it is. I've spent a lifetime trying to understand how regulators think, and I have failed. But they took over. They literally took over the bank, and I don't know what the agenda was. But the important thing here was, and again, I'm going to blame the regulators. They were the ones who drove the banks into treasuries. They said, if you hold treasuries, we're going to go easy on your capital requirements. Go into treasuries, and treasuries are safe. They will pay. That doesn't mean that they don't have interest rate risk, and that was what was the major problem with these banks, and remains a problem with banks. That is an ongoing risk, but it was a special risk for the guys who we lost a year ago.
So in the case of Republic First, not to be confused with First Republic, which was last year, Republic First, what was the situation there then?
I don't know the details of that one, so I'm just going to beg off. I don't know what their particular problem was. We can come back to this later, but smaller banks are having a terrible time raising capital, and the regulators keep pushing capital on them. And I'm not suggesting in this respect that there's some nefarious thing going on, but that has been all the banks that have had trouble have been undercapitalized, at least by the standards of the regulators, and they've been forced into much more expensive ways to raise capital.
Right. And I do want to talk about that. Maybe we will go there, then we can go back. I know there's some other risks, but about how they're going to get this capital.
The problem is that the chief way that smaller banks, regional banks, have raised capitals is through M&A. And they effectively are selling their particular brand to a larger regional bank that can capitalize them and that has access to capital and can meet the standards the regulators have or the standards or common standards in the industry. And M&A activity has virtually dried up. Last year, the only 23 is the most recent period for which I have data. There were less than 100 M&A events in the United States. That is less than a third of the average for the prior 5 years. So this leaves the smaller banks, and Silicon Valley would count in that if it was still around. This leaves the smaller banks having to look elsewhere to private equity and other places. And without going into the details of these alternatives, they are all much more expensive than M&A. You're selling, if you're a small bank and you're selling yourself to the next largest regional bank or to raise capital, because you have to raise capital, they're buying your branches, they're buying your brand, they're buying the region. And so they're getting more for their money. They're willing to do it cheaper than they otherwise would. But if you're using private equity or you're using some foreign entity, they don't want that. They simply want the return, so you're paying much more to get the capital. And banks are less liquid than they were, but we can come back to that.
So since it's tough to get deals done in banking right now, and private equity is starting to come in, are we seeing a trend? Are we going to see, I mean, private equity is in a host of industries, but the banking industry, I think, is pretty new. Do you think you're going to see more of this because traditional M&A is difficult to do?
I think we're going to see more private equity everywhere because investors are having trouble making money, and the private equity is promising a higher return. And so that's where the ultimate investment money is flowing into private equity. They have the money, and they will be the source. So it's more than banking, although banking is included.
Yeah. So I told you that I'm working with a regional bank right now who acquired a bank, or intends to acquire a bank, was delayed a year because of the regulators. They finally got approval, and the list of conditions on the approval was enormous.
Well, unfortunately, with regulators in any industry, there's no balance. When you're an investor or you're a retailer or something, there's always a balance. I'm going to charge as much as I can, but I can't charge too much. There's always a balance, and the regulators don't have that. It's all safety. Now, forgive me for editorializing. It's a sham because no bank. If you asked a bank to carry enough capital to be safe, completely safe, then it wouldn't make any money and it wouldn't be in existence anyway. So the regulators play this game with capital, 3.5%, 5.5%, something like that, depending on what kind of asset base you have. That's protection for, if we have a recession, that's no protection for the banks.
So we've talked a little bit about M&A. Let's talk about some of the other risks. One of the risks that have really come up a lot in the headlines is CRE, commercial real estate, and the exposure, particularly that a lot of the regional community banks have to commercial real estate. Can you talk a little bit about that? How much of that is real, by the way?
It's really, the commercial real estate is, I have some statistics, that's why I have this little piece of paper in front of me here. On the commercial real estate, it's really crowded into just a few banks, and I can't give you names, but and it depends on what the nature of the real estate is. So the offices are the dangerous place. And let me see, I can't quote a number here, and that's worthwhile. Bear with me. So commercial real estate, two things to say about that. One is that the office vacancy rate remains very high, 20%. That's where the danger is. That's about as bad as it's been since '79. If you can't remember that year, there was a recession that year. But so that's the benchmark. But it's all the commercial real estate vulnerability. We come back to this capitalization thing, is with the regional banks. So the large banks, at least at last measure, were exposed to commercial real estate of all kinds, a little less than $1 trillion in the whole large banking system. But smaller banks have about $2 trillion in exposure to all kinds of commercial real estate. Now, that doesn't mean, that's not the same thing. The offices are the dangerous part, and shopping malls, where the vacancy rate's high. Not as bad as offices. It's about 10% in shopping malls, which is half what it is in office space. But if you're in warehouses or cell towers or retail, street retail, then the situation isn't so bad. So it's not all real estate, it's just the offices, mostly the offices, some of the shopping malls, and then it's crowded into the regional banks, not the big banks.
So Milton, if a bank wants to right-size its CRE portfolio, what does it do? How does it go about right-sizing its portfolio? So say it has a lot of office real estate that it's holding. How does a bank right-size the portfolio? What do they actually go through to do that?
I'm not sure I understand the question.
So a lot of the regional banks are looking to change their real estate makeup, the makeup of the real estate portfolio, because there's a lot of attention on CRE and the regulators are looking at them. So how do they fix their portfolio? Do they sell off? Who are they selling to? Like, how do they get themselves out of the CRE hole?
Well, to some extent, they may be stuck with the real estate, and they can sell it at a loss, but then they have a capital problem.
Okay.
The problem a lot of these regional banks have is that they don't have that many options. One of the reasons they're in commercial real estate is they're not like a Citibank or a JP Morgan, which has countless options of where to invest their money. They're just in their region.
Right.
And real estate, what is the biggest area in most regions of the country? And the offices were very attractive at one time. Then come COVID.
Right.
Yeah.
So I don't know how we got this far without talking about interest rates and the Fed, but I know that that's top of mind for everyone. Curious of your thoughts. I believe it's tomorrow CPI is being reported. I know that there will be an analysis of how the Fed's going to digest however those numbers come out. What is the impact on banks right now because of where we are, and what do you expect to see?
Well, we'll start with the Fed. I know the consensus figure for tomorrow is about 5% at an annual rate for consumer prices. I have no idea what they're going to come out like. They might actually be a little lower because oil prices have come down. But Jay Powell, if you're playing his game, you want very much. Right now, I think Jay Powell would be very happy with that 5% at an annual rate because it gets him off the hook. If it was too much lower, the street would be braying at him to lower rates, and ultimately the White House is going to start leaning on him to lower rates because November comes whether we want it or not. So he probably wants an excuse not to move. And if the number were to be much higher than that, he would come under some pressure within the Fed to actually raise rates. And he doesn't want that. He's very political, and we can come back to that because I think it's a fun story. If it's too much lower than that, then he has all the pressure on the other side. So I think if Jay Powell would love to see that consensus number because it allows him to say, no, we haven't won the battle yet, but we don't have to squeeze anymore, which is what he wants to do, I think. In fact, I'm pretty sure. But he's going to come under pressure to cut rates from political side, and he is very political. We'll go where you want to go, not the story I want to tell.
Well, now I kind of want to know the story you want to tell.
Jay Powell is very political. He's going to come every Fed chairman has come under pressure from the White House, and he's going to come under this pressure. Let me say from the start, if he cut rates tomorrow, it would have very little effect on the economy, certainly not enough time between the election. So it would all be cosmetic and market reactions. and he'll come under pressure. Two stories about Jay Powell to capture how political he is. And he's no different than any other Fed chairman. When he was working for Trump in 2019, Trump leaned heavily on him to cut rates. And Jay Powell was lionized as a great hero for resisting the orange man. But then he eventually gave in. And his excuse for giving in was we had put tariffs on Chinese goods, which is no excuse at all. He was looking for an excuse to bow to the White House. And I'm sure if the White House were leaning on me, I would crumble too. But if you're putting tariffs on goods, it's inflationary. There's no excuse to cut rates, but he cut rates, even before the pandemic. And they were going back to zero even before the pandemic. Once we had the pandemic, he was off the hook. He could bring rates down to zero and no one would complain and everyone would be cheering. Then again, under Biden, in 2021, when we had the worst inflation numbers, he kept saying, the White House kept saying, nothing to see here, this isn't inflation, it's going to go away, don't be worried. And Jay Powell he didn't coin the word, but he used the word heavily transitory. This is just transitory. And oddly enough, and he was going to be reappointed in 2021, and oddly enough, as soon as he was reappointed, he suddenly said, we have to retire the word transitory, this is a terrible inflation, and we're going to raise rates, and started raising rates. So he was playing politics in two ways. One, to yield to the Biden White House, which did not want anything to interfere with the recovery from COVID, understandably. And two, he was looking to be reappointed. And once he got the reappointment, he said, we have to fight inflation. And we started this effort to fight inflation by raising rates. So two instances in which Jay Powell has shown a tremendous sensitivity to politics, and it's going to happen again. And I would add that he has another reason to try to help Biden be reelected, because Trump has said, I'll fire the man when I take office. So he has every reason to help the White House. He'll cut rates. As I said, it won't have an impact on the economy. It can't. It doesn't have enough time. Even if he did it this morning, it wouldn't have enough time to have a real economic impact. But if he cuts rates, it will make the market very enthusiastic. You'll have a big jump in the market. We're free. He can say that the inflation, even though it doesn't look like it's back down, it is. We'll go back to the transitory game. And that will create a lot of enthusiasm running into the election. And that's really what the president wants. I don't know about Biden, but I know the White House knows that we're not going to affect the economy by a rate cut in October, which is my guess as to when we'll have it. So there's my story.
Okay. So we're going to see a cut. It'll be before the election. You think it'll be October?
That's my guess. Please use that word, guess.
Before we move on from banks, because I want to talk about some other macroeconomic things, do we have any questions from the group for Milton?
About banks, huh? I got a couple for you. So I'm sensing a theme when it comes to regulators. So I'm going to ask you to use your own words, moralize, editorialize, and God forbid, even regulate. So thinking of small regional banks, what should their capital cover ratios look like? What's appropriate? And what should their investment portfolio look like if not treasuries?
One more time.
If not treasuries, what should they be investing in? And if not, whatever the current capital cover ratios are, what should they be? And I realize I'm asking you to play God here, but go ahead.
Well, I'm not going to tell the banks how to invest their portfolios, but I would say that rather than treasuries, because we know treasuries, they're safe, the government's going to pay. And they print the money with which you pay for it. So they're going to be good for the dollar amount. Whether it's worth anything is a separate issue. But they're not safe in terms of interest rate risk. So I would say to the banks, do what every investor knows what is the best thing to do. Diversify your portfolio, match it to your needs, and So treasuries can be a part of the portfolio, and business loans could be another part, and commercial real estate, if it's not in a particularly dangerous situation, can be another part of the portfolio. But for God's sake, have a diversified portfolio. With Silicon Valley and even Signature, which is still a mystery to me why they took over Signature, but even Signature did not have a particularly well-diversified portfolio on the asset side. Right now, the banks are still heavily in treasuries. They were driven into them by the regulators. If someone says to you, we're going to demand another percentage point of capital if you invest in business loans, but you can invest in treasuries, then you'll buy the treasuries. So effectively, the regulators have made this problem for us, not for themselves. Their jobs are secure.
So, second of the two-part question, if it's okay, and this is provocative in this context, but listening to you both speak, and these are good interview questions, I think about, maybe my knowledge is wrong here, but the history of small banks. They grow up as sort of like an almost monoline kind of business, right? They serve, there's only so much diversification they can do, right? So short of M&A, I mean, what is the future like? Do we have too many regional banks? Because, Jamie Dimon can get into every business in the world. They can't, other than selling themselves and maybe finding a better real estate portfolio, which, as you both discussed, is hard to do. Like, what's the end game of small regional banking? It seems to me that, I'm not trying to kill your client, but there may be too many.
There may be too. Well, unfortunately, there was they've been forced into real estate. They've been forced into more dangerous situations than the large banks. So I'm not. The word "should" is a hard word for me to use, but if the M&A activity remains as low as it is, and as you pointed out, the regulators are in some respects interfering with the M&A activity. It's not the only thing, but the regulators are interfering with it. Then we're going to have to order it. And we've done that before. In 2008, there was a great deal of M&A. It was, you're going to buy him, and that's the end of it. And we'll give you a bargain price. Because right now, all the danger, that's overstating. Much of the danger in the banking system lies with the smaller regional banks. And not because they're fools, not because they don't know their business, but because they really don't have the same options that a larger bank has.
Thank you.
So going back to the discussion of lowered M&A and private equity, I'm just wondering, kind of from a broader perspective, obviously we've seen like VC was super popular, and now like PE is super popular. If banks and other companies struggle to raise capital from investors and PE continues to be the large source of capital, do you think that would have an effect, say 5 years down the road?
Think it'd have an effect?
5 years down the road.
Yes, if they can't, if they can't get the M&A, if we can't get the natural, and they have to go to more expensive, they're undermining their bottom line by playing that game. And they already have a problem. One of the other problems the banks face is that with the inflation, their payroll is rising faster than their revenues are rising. And with digitalization, they have to make a lot of investments, even if they're the smallest region. A one branch bank in a small town has to digitize, and that's an expensive thing going on. If they have to pay more for their capital, it just squeezes their bottom line even more. Now, to come back to your question, the M&A can be spurred if they give a better price. But they're going to be selling not at a loss, they're going to be selling cheap.
Right.
Maybe everyone's been a bit of a doomsayer, so maybe you could talk about the fact that there are so many banks. What is the sort of secular thesis? Why does America have so many regional banks in the first place? I grew up in a country that had 5 banks, 6 banks, maybe a few building societies and a few small things, but nothing like the many thousands of regional banks. And I appreciate that is half the size of what it was in 2008, but it's still a lot of banks. And so there must be a reason, even if it's a historical reason, why. Are they meeting some local need? Do they understand something about local market dynamics that big banks go? Do they support, or do they go into places where big banks don't? What's the other case? We've heard lots of reasons why they shouldn't exist, or maybe they won't. But what's the other case?
Well, the history is that the United States, unlike Britain, has always shown a great distrust of concentrations of power, particularly financial power. And this goes back to the days of the Revolution, the great debate between Hamilton and Jefferson on concentrations of financial power. And so you had a lot of legal structures in the United States that the state of Illinois, up until the 1980s, had a unit banking law. You could not branch. So you had these big banks in Chicago. They were wholesale banks. They raised their money in New York and elsewhere and lent to big corporations all over the country, but they were one branch. And so there was this, and when I managed money for the state of Oklahoma, I was forbidden to buy financial firms. There was such a distrust politically of this. And so it created this growth of tiny entities. And so there was that's historical thing. The other thing the United States had, which was a repeated disaster in the 19th century, is land banks. There was a lot of free land, and the land banks would come in and lend you money, and you would put, and they would and mortgage property for expansion, whether it was industrial or agricultural expansion. And what they could do then is, as their asset base, the land, rose in value, they could lend more. And of course, the lending raised the asset base that much more. And so the banks actually, the financial structure built on itself. It was extremely dangerous, and it created a lot of the busts in the middle of the 19th century. But that too cultivated the idea of having a local bank promoting local commercial real estate. That I think is the historical origin to this, but it was always dangerous. The land banks were the cause of a lot of the busts in the 19th century, and it remains that way. I mean, if they could raise capital, cheap capital in some other way, they could exist. And you would think that in this age where you have a retailer can be located in Hawaii and sell to me in New York instantaneously, that the smaller banks could diversify, but they don't seem to be able to. They certainly can't diversify their deposit base, and that's a big problem.
One of the trends that we're seeing, and I know we don't have time to get into it today because we're going to run out of time, but to Jean's question, Gabby's, as well as Dan's, is this trend of credit unions starting to buy the smaller banks as well, and they're actually coming in and making some of the plays where traditional bank M&A isn't happening. So I think we might see more from the credit union space buying the community banks. I think there have been 4 deals this year already. So that'll be in our next banking session with Milton. We'll talk about that one. Any other question on banks? I did want to cover just some other current topics. Yeah.
Maybe you're going to talk about the election, but I'd be curious about the intersection between potential outcomes of the election, presidential, and regulatory agenda, regulatory activity, etc.
Oh, well, we're out of time. Obviously, Biden is, he has a lot of pressure in his party. I have no idea what he thinks, but Biden has a lot of pressure within his party to regulate. Ms. Warren has a lot of power within the party, and that's what we've seen in these last few years. And Trump would try to reverse it, and underscore the word try. because we did discover the last time he was president that he faced a great deal of resistance, and there is. And to be fair to the regulators, there's always a good reason to be on the other side of the deregulation question. And it's, if you look at the, when the regulators call for public responses, you can see that there are powerful arguments on all sides of these questions. So reversing this thing it's an unlikely outcome. And what should be, I can't say, but it is an unlikely outcome. I think the regulators have created a problem for themselves here, and hopefully they've learned their lesson that they should diversify instead of driving everyone into treasuries to support treasury spending. But I don't think we're going to see a great change in this thing. I mean, I'd be very surprised, even if Trump were elected by a landslide.
So just to build on your good question, the scenario you're laying out there, in other words, it's less of a scenario of reversal of regulations and rules and more about perhaps slowing the pace of new regulations and
or better yet, introducing an element of investment wisdom into this thing instead of just don't take any risk, which is where we've been now. And it's an amazing thing, just a personal anecdote here. A friend of mine who's fallen into relatively bad straits has asked me to find out about reverse mortgages for him because he needs some cash flow. He's an older man and needs the money. And I was looking at reverse mortgages. I wanted to find out, give him the whole picture. And I read the Consumer Protection Agency has a page on reverse mortgages. And if you read it, you wouldn't go near them. Well, they actually can be a very helpful device for people who are short. But it's like, don't do this, and they can clip you here, and they can ruin you there, and it's really not what you think it is. And I said, look, I know enough to know that this is biased. And that can change, but it's hard.
I mean, somebody who's done, I bet I'm not alone in this, who's done a lot of work trying to communicate rules and regulations, and not to dump on a profession here. My most significant person in my life is a lawyer, but lawyers do not if you try to humanize risk and make the pathways very clear, compliance is not going to let you get that out the door. So maybe somebody at the Consumer Protection Agency tried to write an honest accounting of reverse mortgages, and I guarantee you that compliance and legal went all over it and said you got to lead with the risk.
Look, they're in the business of protecting people from risk, and to exaggerate the response, don't ever get in a car. 30,000 people a year die in car accidents. Don't drive. That's the ultimate in avoiding risk. Don't cross the street. Don't get out of bed. And you have to balance that because you don't want people to walk around taking unnecessary risks, but at the same time, and the regulators lean one way or the other. And they're in an environment now where they're leaning heavily on, and I don't think many of them understand risk. And then on the other hand, you have a lot of pressure, for instance, from the brokerage community saying they don't want 3-day settlement on securities. They want next day settlement on securities because that saves them having to borrow money. And they're putting a lot of pressure on the regulators to speed the process up. What that's going to do to the back room is another story.
Part of the scenario you just laid out would argue for, are the best people doing it? So if you want to get better understanding of risk into regulation and lawmaking, you need to have people who've done it for a living do it. And that's not going to happen. People leave the SEC to go join the street. They don't go the other way.
Well, I'll say this. Part of the problem is that they're all lawyers, and it's not to say there's anything wrong with lawyers, but lawyers have the same problem as the regulators have, leaning on protecting against risk. But some of the agencies, and I say this to be hopeful, some of the agencies, the SEC I know, actually has a program called fellowships where they take people who've had careers in the investment industry and bring them in to brief the lawyers, to explain to them how these things work and why what they think is a risk may be an answer to the problem. So I think someone in Washington is trying. That's a hopeful sign. We're getting very deep into politics here. Change the subject.
We're also getting, this breakfast is going to turn into a lunch if we don't cut it off here. I do want to talk about one topical thing, and I had a humorous moment when I saw Milton this morning. I came up to him and I said, would you mind if I asked for your take on meme stocks? And he looked at me and said, Roaring Kitty is back.
Yes, he is.
As someone who's been doing this for a while, I mean, I'm really curious. I've heard so many takes, manipulation. What do you make of it all?
Well, what Roaring Kitty did probably isn't illegal. He created a kind of a pump and dump environment for the stock, but I don't think he intended to do that. Well, maybe he did intend to do that, but he did it in such a way that it wasn't illegal. Now, I'm going to sound very cruel when I say this, but the fools who chase these stocks are adults. It's their money. Good luck. I'm not going to.
Adults.
Pardon?
Not all. I mean, maybe they're over 18, but a lot of them are quite young.
Yes, they are quite young. It's their money, and if Robinhood wants to help them, maybe we should look at Robinhood. And he's the guy who's pushing for same-day settlement, or maybe T-1 for settlement, because it saves him money on these trades. One of the reasons he had to stop trading the last time is because he couldn't stand the margin requirements.
The trade settles before you even know you want to do it.
Because DTCC put the brakes on.
Yeah.
Yeah.
So, but my attitude is I don't care if their mom and dad let a 16-year-old chase a stock. That's mom and dad's fault. I'm not going to cry for them, and I didn't cry for the hedge funds. Shorting is an extremely dangerous activity. The chance for loss is infinite, and they should know better. They probably know better now. As a consequence, this probably won't go as far as it did because you don't have people on the wrong side. It was interesting to me, talk about regulatory safeguards, that at the last time Roaring Kitty roared, we were shorting in the United States much more than 100% of the stock, which means that somebody is not regulating correctly.
Naked shorts.
Naked shorts, a lot of naked shorts. I think 30% were naked. And that's very dangerous. So I'm hopeful that they've corrected that. But Roaring Kitty is back, and it's good fun. I did a talk, not here, I did a talk once for a group when Roaring Kitty when it had just ended, and I was accused of being heartless, that I didn't care if these people lost money. I said, well, Roaring Kitty did very well. He dumped at the right time, evidently, but others didn't. And I would venture to say, and this is just a guess, I don't have data on this, that more people lost money than made money. I mean, these kids were bragging how much they paid for a stock. So take advantage of, well, sheep were made to be fleeced. I didn't say that.
Any final questions for Milton before we wrap up?
Don't let me end on that. That was cool.
I will just say on that last point that it is an ex-journalist many, many years ago, but it engenders a much larger discussion about what promotes a trading culture. So the discussion you and I are having beforehand, about investments, I mean, if people were actually listening to sound personal financial advice, we wouldn't have trading cultures like this, but we do. That's America. Is it the media to blame for it? I mean, Like what causes people to chase tips in the first place? It's pervasive in our culture.
Well, I wish the high schools would teach bookkeeping at least. It's not, look, investing fundamentals are not rocket science. Anybody who can get a high school degree can understand the fundamentals of finance, and unfortunately we don't teach that. At the risk of sounding like a bitter old man, we're not even teaching reading anymore, so why the hell should we teach investing?
Thank you so much for coming, Milton. Every time you come, we laugh and we learn something.
You're kind. Thank you. Thank you.